To take a call at the bill's second reading. The bill seeks in particular to simplify and clarify GST issues in relation to commercial land. It would bring real advantages for the GST treatment of suppliers of commercial land. No longer would parties have to determine whether the sale of land was the sale of a going concern. An overriding purpose of the bill is to stop fraudulent schemes known as Finnish schemes, as mentioned by my colleague Stuart Nash, where the IRD refunds GST to GST-registered purchasers, but no corresponding payment is made by the vendor to the IRD, as the vendor is deliberately wound up before such payment is made. The bill makes a number of tax-related amendments and introduces changes to KiwiSaver legislation, ETS units, PI schemes, and the tax treatment of superannuation funds. Labour supports this bill. It introduces some sensible changes and a number of remedial amendments, but we do have concerns as well. Regarding the new rules for change in use adjustments optional for certain financial service providers, a key concern was the potentially significant compliance costs for financial service organizations such as banks and life insurers. An adjustment would be required for each asset used for both taxable and non-taxable suppliers. In response to submissions, the Finance and Expenditure Committee has recommended a new provision which allows a person who principally makes suppliers of financial services to use a different method to the new rules if the method meets certain criteria, including, for example, the method is fair and reasonable. Some commentators and submitters, however, still remain concerned because it is not clear whether the proposed amendment will achieve reduced compliance costs. Regarding the definition of land, the FEC has recommended a carve-out for most commercial leases from that definition following submissions by KPMG and others. This means that most commercial leases will not be subject to the zero rating provisions for land. It is sensible because the inclusion of commercial rentals would have caused an increase in compliance costs for landlords. As KPMG submitted, this was not warranted given the very, very low risk of Phoenix fraud in these circumstances. In respect of the zero rating for land sales, the FEC has recommended amendments to clarify that the test for zero rating land transactions should be at the time of settlement. This is a departure from the previous principle of testing for zero rating at the time of supply. However, according to some experts, this approach does not appear to be particularly practical. I look forward to more deliberation on this particular part. This bill makes a number of amendments to a KiwiSaver scheme. It is regrettable that the government did not use this bill to undo the damage it did to the scheme in cutting KiwiSaver. 2 years and 2 budgets, and what they had to offer is that the national government's savings plan, if any, has so far consisted of cutting KiwiSaver scheme and cutting contributions to the super fund. So cutting and cutting in combination represented the national government's savings plan. New Zealand's savings history timeline is straightforward. In 1974, Labour Kirk government introduced a compulsory contributory superannuation scheme. In 1975, Muldoon government closed the scheme. In 2001, Labour Clark government established the New Zealand Superannuation Fund, and in 2007, Labour's KiwiSaver came into force and it was expanded in budget 2007. But in 2008, national halved effect of KiwiSaver to pay for tax cuts. In 2009, national suspended contributions into the New Zealand Superannuation Fund until 2020 or until Crown accounts were back in surplus. In 2010, National extended a suspension of contribution into the New Zealand Superannuation Fund until 2018, despite a forecast surplus in 2016. In his opinion article published in the New Zealand Herald on 21st August this year, Brian Gaynor stated very strongly that National Prime Minister Robert Maldon's termination of the superannuation in 1975 was the worst economic decision by any New Zealand government in the past 50 years. Let's have a look at the Australian and New Zealand figures on a per capita basis. Australians have 56,000 Australian dollars of superannuation funds, whereas Kiwis have just 5,500 in New Zealand dollars. 5,500 in New Zealand dollars versus 56,000 Australian dollars. Now, Australians have 29,200 Australian dollars of net overseas debt, while Kiwis have 35,900 New Zealand dollars. Since mid-2000, Australia's total superannuation assets have risen nearly threefold, from 484 billion Australian dollars to 1,257 billion Australian dollars. Mr. Gaynor said in his article that a substantial majority agreed that Maldon's decision was a disaster for the country, particularly as the compulsory scheme was replaced by national superannuation, which cost $8 billion a year and funded from taxes. The abolished scheme would have been worth an estimated $240 billion plus in 2007, and would be worth around $255 billion today, using the same conservative investment refunds projections. This $255 billion, or $58,300 a head, compares with our current superannuation assets of just $24 billion, although the latter does not include the $16 billion held by the New Zealand Superannuation Fund. How disastrous it was because of Prime Minister Maldon's decision. It turned our country from being a potential Switzerland in the Southern Hemisphere into a low-ranking OECD country that is falling further and further behind its next-door neighbour. I thank Mr. Brian Gaynor for his analysis, which is a wake-up call for anyone and everyone who is concerned about our country's future. If Finance Minister Honourable Bill English is so worried about the warnings from the ratings agency Standard & Poor, he should be worried about our very poor performance in savings, because compounded by our household's debt mountain, it leaves our economy very, very vulnerable to further international shocks. It is very unfortunate that the National Act government terminated the annual contribution to the New Zealand Superannuation Fund and changed the KiwiSaver contribution formula from 4% employee/4% employer to 2% respectively. Halting contributions to the current superannuation fund has cost the taxpayer millions and millions of dollars and has undermined the certainty and future of the super fund. It was a short-term decision taken for purely ideological reasons, because National has never been committed to the super fund. The core issue, Mr. Speaker, is the sustainability problems of New Zealand superannuation as the baby boomers move into requirements. Maldon will be judged and has been judged by history. I say to the current national government, in the context of this tax bill, instead of keeping adjusting its policies based on the latest opinion polls, the government should be focused on reducing external debt and increasing internal savings. Thank you very much.